Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the endless stream of corporate jargon and financial secrets. And today we're diving deep into Alussa Energy Acquisition Corp, ABS's latest SE filing. Get ready because this one's a wild ride with some serious implications for both investors and the future of energy. You know how SPACs are all over the news? Well, this report pulls back the curtain on one aiming to shake up the energy sector. We're talking about a company that is essentially a blank check ready to merge with an energy or power infrastructure business. But what does that really mean for you and your money? We're going to break down the numbers, the risks, and the strategy that could define their next move. And hey, before we dive in, if you love getting these unfiltered corporate insights, make sure you are subscribed. We drop new analyses every week. Also, join our Discord community linked in the description below to talk all things finance and investing. So Alussa Energy Acquisition Corp, the FEC is a special purpose acquisition company, a SPAC think of them, as a company created with the sole purpose of raising money to buy another company. They do not have any real business operations of their own at this stage. Their goal is to find a private business, usually in the energy and power infrastructure sector, and combine with it. The big story here is that as of the 10th of October 2025, they are still looking for that perfect match. They have not identified any specific target company and have not even started serious discussions. This means right now they are essentially a shell with a plan and a whole lot of investor cash waiting to be deployed. Now let us get to the juicy part, the financials. As of the 30th of June 2025, they had a measly $520 in cash. Yes, you read that right, $520. And get this, their total liabilities were over $755,000. That definitely screams I need money. The as adjusted column shows the picture after this offering. We are looking at around $251 million in total proceeds after offering expenses. Out of this, a massive $250 million is going straight into a trust account. This is standard for SPACs. This money is meant to fund the acquisition and is protected from general business use until the deal closes or the company liquidates. The remaining bit, about $1 million outside the trust, will cover ongoing expenses. This is where it gets interesting. Right off the bat, there are significant fees. Underwriting discounts and commissions are around $7.75 million, and an additional advisory fee of $7.5 million will be paid out upon completion of the business combination taken from the trust account. Think of it as a success fee for the bankers. This means that even before they find a deal, a good chunk of the money raised is already earmarked for payment to others. And here is a real eye-opener based on the numbers as of the 30th of June 2025, and assuming the full use of underwriting fees and other expenses, the net tangible book value per S-share is actually negative. We are talking about a deficit of over $2 per S-share when the offering price is $10 per unit. This highlights the dilution that public shareholders face immediately. The founders got their shares for practically nothing, and that disproportionately large stake is a key factor in this dilution. Essentially, the initial investors are footing the bill for the founders' significant advantage. Let us talk about those founder shares. On the 6th of September 2024, an entity owned by one of the directors paid only $25,000 for over 7 million Class B ordinary shares. These shares were then transferred to the sponsor. These founder shares will convert into Class A ordinary shares at a later date. The report mentions they represent 20% of the company S shares after the offering, which is a huge chunk. This structure is a major source of dilution for public shareholders, and the sponsor is very likely to make a substantial profit even if the business combination struggles. According to the filing, the sponsor and executive officers and directors are considered promoters under securities laws. This means they are viewed as having a significant role in the formation and early business activities of the company. It is basically a disclaimer that these key individuals are deeply involved in getting the SPAC off the ground. Now for the risks, and there are quite a few. A significant one is the potential conflict of interest. Our officers and directors have other business commitments and responsibilities. This means they might not be able to dedicate all their time to Alussa Energy. This could slow down the search for a business combination or even impact the quality of due diligence. It is a classic SPAC problem where the people in charge are juggling multiple projects. Another major risk is the fierce competition for attractive acquisition targets. The market is flooded with SPACs, and many good companies are already taken or are wary of SPAC deals due to public perception, which could make it harder and more expensive for Alussa Energy to find and complete a deal. This could also lead to them settling for a less than ideal target if they feel pressured by their deadline. Here is another red flag. Alussa Energy states they are not prohibited from pursuing a business combination with a company affiliated with their sponsor officers or directors. While they say a committee of independent directors would get a fairness opinion, in such a case it still opens the door for potential conflicts of interest. This means the deal might not be purely in the best interest of all shareholders. And if all that wasn't enough, being a Cayman Islands exempted company introduces its own set of challenges. The filing points out that enforcing legal rights in the US against the company or its directors could be difficult. So if things go wrong, you might have a much harder time seeking recourse compared to investing in a US incorporated company. It means less protection for your investment. Now onto the accountant's opinion with Smith Brown PC. The independent auditors explicitly state there is substantial doubt about Alussa Energy Acquisition Corp. I2's ability to continue as a going concern. This is a serious warning sign. It means based on their assessment, they're not sure the company will be able to meet its financial obligations in the near future without securing additional funding or completing its intended business combination. Essentially, they are saying this company might not survive if the deal falls through. Looking at the balance sheet for the 30th of June 2025, we see $85,000 in outstanding borrowings from a related party. Specifically, it is a promissory note from their sponsor. This shows that the company is already relying on its sponsor for funds even before the IPO. It is a common practice for SPACs to get these loans, but it also highlights their immediate liquidity needs. Let's look at the operations. Since they haven't completed a business combination, they have no revenues. Their expenses are minimal, mostly general and administrative costs. For the 6 months ended the 30th of June 2025, it was just under $2,000, and for the period from inception in August 2024 to December 2024, it was about $74,000. This is typical for a SPAC before a deal. The real financial story will be in the post-acquisition period. So what is the final verdict on Alussa Energy Acquisition Corp. 2? It's a company in the very early stages of its hunt for a business combination. The financial tables show a company heavily reliant on its upcoming IPO for survival and facing significant dilution for public investors. The risks outlined are substantial, including conflicts of interest, fierce competition, and the ever-present possibility of not finding a suitable target within their deadline. The auditor's going concern warning adds another layer of caution. While their management team has experienced, the path forward is fraught with challenges. The true value of this investment hinges entirely on their ability to secure and successfully integrate a promising energy company. Investors should be aware that this is a high-risk, high-reward scenario with the odds heavily stacked against a positive outcome without careful consideration of the detailed risks. That is our deep dive into Alussa Energy Acquisition Corp. The second. SEC filing, what do you think about their strategy and the inherent risks involved? Let us know your thoughts in the comments below. If this breakdown was helpful, please give it a thumbs up and subscribe for more unfiltered corporate insights you want to miss. And as always, join our Discord community linked in the description to keep the conversation going. Thanks for watching, and I'll see you in the next video.